The market has gone crazy. Every other day the market is crashing, then it starts to rise again, then it decides to tank. Gurus tell you to buy the dip, except some gurus, they decide to sell everything. Then the market rises again until the chair of Federal Reserve, Jerome Powell, says that the Fed is planning to increase the interest rates in March to combat inflation. And then the market tanks again. Well, at least Tesla beats on earnings and revenue, which means that their stock is going up in price. Oh, what the f***? Yep, the market has gone crazy. But how can you know if the dip is really here or if the market will crash even more tomorrow? Not to mention, the market might crash for the next 3 weeks. Or perhaps you don't have any money to invest at the moment, which makes you mad because you might lose all those amazing profits. And because of that, you decide to sell everything so you can buy them back cheaper soon. But then the market decides to rise the next day. Well, now it's time to stop guessing, because today I am going to tell you what you should do when the market is going crazy. The answer is actually quite simple, nothing new, and everybody knows what it is, yet nobody cares enough to actually do it. Buy the dip. That is actually the first thing that you should not do. Of course, it would be better to invest here than here, but how can you know here that the market will rise tomorrow? Of course, you can get lucky every now and then and buy at the right time, but it's still a bad strategy. In fact, this research made by Schwab Center for Financial Research solves it perfectly. Let's say that you are here, the mastermind behind timing the market perfectly, and here is your best friend who always just invests immediately after receiving the money. You both receive $2,000 at the beginning of each year. So basically, starting from the year 2000, you are buying here, and your friend is buying here. Now, obviously you will make more money because in this example you are the market guru that buys exactly at the right time. Instead of investing at the beginning of 2001, you managed to buy at the lowest point of 2001, September 21st. Then you managed to do that for 20 years in a row. But let's be honest, it's not possible to do this for your whole life. Most of us won't probably ever get lucky enough to buy on the exact right day even once. But if, and it's a really large if, you managed to do this, according to the research you would have $151,391 by the end of 2020. Now what about your friend that decided to be boring and invested $2,000 at the beginning of each year immediately after receiving the money? She probably made a lot less money than you, right? Well, actually not. By the end of 2020, your friend would have had $135,471. The difference is less than $16,000, yet you had to know the exactly right day to invest, while your friend just dumped all the money into the market and waited. And if you actually ended up missing a couple of those all-time low days, the result would have been even closer. Fun fact, my friend has been keeping all his money in a savings account with a 1% interest rate since late 2018, waiting for the market to crash. In 2020, it was almost his time to go all in and buy that lovely dip. Since COVID-19 was not going anywhere, he decided to wait a little longer. Oh well. Maybe this year it's finally his time to hit the jackpot. If he had invested all that money at the end of 2018, he would have got an annualized return of around 22% instead of that 1%. The research also shows that it's even better to time the market completely wrong than it is to stay in cash investments. Well, instead of buying the dip, maybe you should sell everything and buy them back cheaper. What a great idea! For example, you could sell them here and buy them back a month later. Oh no. Selling everything during market crashes is something that all the highly successful investors tell you to never do. And the reason for this is pretty much the same as explained earlier, you cannot time the market. The even bigger problem with selling everything so you can buy it back at a cheaper price is the fact that you would have to be able to time the market twice. First, you have to know when to sell your stocks, and then you have to know when you should buy them back before it is too late to do that. While even a monkey might be able to accidentally guess the right time once, good luck doing it twice in a row. However, I want to point out that while it is definitely not the smartest thing to sell your investments just to buy them back, for some individual volatile stocks it might be a good idea to sell them at some point, since their stock price doesn't really correlate with how well the company is performing. For example, stocks like Netflix and Tesla, and many other stocks too, especially in the tech field, can be way overvalued at the moment because of high future expectations, and when the market crashes, pretty much nobody knows what will happen to those stocks. But again, timing the market won't probably work, and you should not sell your index funds just to buy them back later. It won't work, at least according to history. Seeing your portfolio go down thousands and thousands every day is of course something that makes us feel awful. We have been saving money for years just to see it all go in a couple of days. But it's something that every investor should get used to, because around once every 10 years the market crashes, but in the long term these crashes doesn't seem too bad. For example, let me cite the best source available on the internet, Wikipedia. On October 24, 2008, many of the world's stock exchanges experienced the worst declines in their history, with drops of around 10% in most indices. But as a long-term investor, which I consider someone that invests over 30 years, it looks like absolutely nothing too crazy happened during 2008. It is this small downhill here, doesn't look too bad, right? So what should you do then? As you can see, there are basically three problems we are facing. We are trying to time the market by buying the dip, we are trying to time the market twice by selling all our assets just to buy them back later, and lastly, we are letting our emotions make the decisions for us because we can't handle the stress of seeing our savings go to the trash can in just a couple of days. So what is the solution to all of this? No, you don't have to sell your kidney to be able to buy the dip after you first missed the bottom 3 times. What you have to do is simply like the video and hit the subscribe button. In all seriousness, the answer to the problem is so simple: making an investment plan. That's really it, that's all you have to do. And of course, you should also follow your plan. It is so simple yet effective thing, yet most of us still won't bother doing it. With an investment plan, it is easy to keep on investing no matter what is happening in the market. In fact, you don't really even have to care about what is going on in the market if you're just doing what you have decided to do. You could even automate your investments each month, so you don't have to even open your portfolio and see all your life savings disappearing. This method of investing every month is actually one of the best ways to invest, at least if you're investing in index funds, and it's called dollar cost averaging. As you can see from the research shown earlier in this video, dollar cost averaging resulted in pretty much the same result as investing immediately at the beginning of the year, meaning that it is better than timing the market wrong, and not a lot worse than timing the market perfectly, and definitely better than staying in cash. The best thing about investment plans is that they don't even have to be that complex for them to work. They can simply have just your goals, how much risk can you take, how do you plan to allocate your assets, and how long do you plan to invest. In fact, it could be even simpler than that. Just decide that you're going to invest using the dollar cost averaging method, and you are going to do that for 30 years. Now just continue investing for 30 years, don't worry about market crashes that happen every now and then, don't try to time the market, and don't lose all your money by panicking and selling at the wrong time. Let me end the video with a quick example of how you can create your investing plan right after watching this video. First, find out how much money you are making each year. Let's say that in this example we are making $50,000 a year. Now find out your costs. Let's say that we are spending $30,000 every year. This means that we have $20,000 a year to invest. Next, think about how much risk can you tolerate. If you like to take risks, you could decide, for example, that you want to invest 20% of your portfolio in a single volatile stocks or in cryptos, for example. For the rest of your money, 80%, you decide you want to invest in index funds using the dollar cost averaging method. This means that every year you are investing $4,000 in riskier investments and $16,000 in index funds. Since you decided that you want to use the dollar cost averaging, you are going to diversify your investments into each month, meaning that you can invest $1,333 in index funds each month. Now choose a time horizon, for example, decide that you won't touch your money in the next 30 years, no matter what happens in the market. And then just follow the plan without listening to your monkey brain panicking every 10 years. Lastly, you want to hit the like button and subscribe for more videos that will improve your future finances. Have a great day and I'll see you soon. Bye!